Good morning. This investment committee meeting is now being recorded for record-keeping purposes. By participating in this session, you are consenting to the recording, retention, and future viewing of this meeting. This meeting is now being live streamed. Thank you very much.
Okay. Are we okay to get started then, Terry?
I was just checking to see if who we have on online. Jim, did you want to go ahead and I guess you could call it to order and Jim could do the roll call for you.
Sure. We all set? Okay. Good morning, everyone. February 23rd.
Oh, I can't hear him.
2021 meeting of the Investment Committee of PA Serves to order. It is 9:53, and welcome to all of our participants, both those that are on the committee as well as others that will be participating today. We do have 4 new members of the Investment Committee, so we do extend a special welcome to them. They are Treasurer Garrity. We welcome Treasurer to both the board and to the investment committee, and we look forward to your input and participation with the committee going forward. Also, 3 current members of the investment committee, 3 current members of the board have just joined the investment committee: Senator John DeSanto, and Greg Jordan, and Greg Thal. So while you're not new to the board, you're new to the committee, and we look forward to your input and working with you going forward this year. Now, at this point, could we please have a roll call? Terry, will you do that?
Actually, I believe Jim's going to do it for you, Chairman.
Okay.
Yep. We're ready here. So we'll go official. Mr. Becker.
Here.
Senator DeSanto.
This is Chuck Erdman for Senator DeSanto, although I expect him to be joining momentarily.
Okay, thanks, Charles. Chairman Philman.
Present.
Representative Frankel.
Here.
Treasurer Garrity.
I'm present.
Good to meet you.
Thank you.
Virtually.
Yes.
Senator Hughes.
Jim, I think Tony just joined. Why don't you ask again?
Senator Hughes.
Here. I'm Tony Marchowski for Senator Hughes.
Oh, Tony. Okay, thank you. Mr. Jordan.
Here.
Mr. Thal.
Here.
Secretary Vag.
This is Alan Flanagan sitting in for Secretary Begg.
Thanks, Alan. Okay, we're complete. Everyone's present. Thank you.
Great. Thank you very much. For the first order of new business is to have the election of the committee chair. And for that, I will turn the meeting over to Terry Sanchez in her role as the board secretary to conduct the election. Terry, please.
Thank you very much and welcome everyone. I'd like to now conduct the election for the chair of the investment committee for year 2021. Nominations are now in order for the office of committee chair for the investment committee. May I have nominations for the committee chair, please?
This is Dave Philman. I nominate Glenn Becker.
Thank you, Mr. Philman.
I second that. Greg Thal.
Thank you. Are there any other nominations? Any other nominations? All right, seeing none, as many as are in favor of Mr. Becker for chairman of the investment committee, say aye.
Aye.
All those opposed, no. The ayes have it. Congratulations, Mr. Becker. You are once again the chair of our investment committee, and very happy to have you as such. Thank you, and you may proceed with the meeting.
Thank you, Terry. Appreciate that. Thank you, committee, for your expression of confidence for me to lead the committee for the coming year. The next order of business is the approval of the minutes for the December 1, 2020 Investment Committee meeting. May I have a motion, please?
So moved.
So, second, please.
Second.
Okay. All in favor, aye?
Aye.
Opposed, no? Opposed, no? Okay, the ayes have it, and the motion is passed. Being no old business, we'll move directly into new business, and the first order of new business is the appointment of the assistant chair, and I would like to appoint Dave Philman to serve as assistant chair of the investment committee. As many as are in favor of consenting to the appointment of Dave Philman, say aye.
Aye.
Those opposed, no. Okay, the ayes have it, and the appointment of Dave Philman as assistant chair of the investment committee is confirmed. For the balance of today's new business, and we have quite a bit of it, I would like to turn it over to our CIO, Seth Kelly, and I will be available for when the motions come up or if there's anything else needed. But for the balance of this session, I'd like to turn it over to Seth. So, Seth, please take it away.
Thank you, Glenn. I've got a box. Okay, it went away. I didn't want to start without the senator in the virtual room. So we are now down to the work plan review, and Bill Trong is in the room. I'm going to let him lead that discussion. So, Bill, if you don't mind, take us away, buddy.
All right, thanks. Good morning and welcome. My name is Bill Trong. I work in the investment office. I assist with managing public market assets as well as other investment-related matters. At this time, please turn your attention to item 6B in board docs. The document name is Investment Committee Work Plan Update. In general, this work plan provides highlights of the items our investment office plans to present to the investment committee in 2021. It is important to note that many of the items in this work plan are an extension of goals established in the agency's broader strategic business plan that we worked through over the last couple of years under Terry's leadership. At this time, I'm happy to answer any questions to save some time without reviewing the entire document. I'm open to answering any questions from the committee. If there are no questions, I'll turn it over to Seth and Chris Houston to discuss the charter.
Yes, thank you, Bill. So my name is Chris Houston. I'm the Deputy Executive Director for Administration and also the Acting Chief Compliance Officer at CSRS. I work very closely with Terry on governance matters, and I'm going to be covering today's agenda item, which is 6C, which is the review of the Investment Committee Charter. The charter provides that every 2 years the committee is to undertake a review of the charter and make any recommendations for changes to the charter to the board. The Board Governance and Personnel Committee also has a role in reviewing charter revisions from the other committees in addition to its own. So it's really a two-step process that we have in place. So to the extent that this committee would be moving to recommend that the charter revisions be approved by the board, it's really contingent upon the receipt of concurrence from the Board Governance and Personnel Committee. In the board docs under item 6C, you'll find a red line copy of the current charter, and the revisions that are made are really primarily focused along some very minor technical changes to terminology. Some of that relates to the reorganization that was undertaken by the agency last fall. But there was one change which is driven by Act 2020-128, which provided specifically that the board is to establish a function within the Asset Committee or I'm sorry, within the investment committee of an asset liability review, if you will. And so there's specific language in there that speaks to that the committee is to collaborate with the investment office to establish and maintain a function to evaluate and manage financial risks associated with SERS's assets and liabilities. So pursuant to, as I said, to legislation which was enacted last fall, we've incorporated that specific direction to the committee into the charter. So I'll open up for any questions if there are any to the revised charter. Otherwise, there is a motion to undertake moving forward with the recommendations as I had outlined. Okay, thank you.
Well, if there are no questions, then we can move into the motion. So a motion is in order for the investment committee to recommend to the State Employees Retirement Board that it approve the amendments to the investment committee charter as set forth in the attached. May I have a motion, please?
So moved, Jordan.
So moved. Second, Philman.
Second, please. Do I have a second?
Second, Philman.
Thank you. May we have a roll call vote, please? Jim Nolan, I think, will conduct that.
Yes, sir. Mr. Becker?
Aye. Yes.
Okay. Mr. Erdman?
Senator DeSanto, aye.
Oh, Senator, sorry about that. Chair Philman?
Aye.
Representative Frankel?
Aye.
Treasurer Garrity?
Aye.
And Ms. Markowski?
Aye.
Mr. Jordan?
Aye.
Mr. Thal?
Aye.
And Alan Flanagan on behalf of the Secretary?
Aye.
Thank you. We have a unanimous summary. Glenn?
Good. Thank you, Jim. So the ayes have it, and the motion is passed. Seth, I will turn it back to you.
Okay, thank you. So I'm going to just take a few minutes before we dive into what would be item D on the agenda, the CIO update, accomplishments and a rebalance update. I just want to share Glenn's welcome from myself and the investment office to the new members of the committee. Look forward to working with you and trying to solve these problems together. So welcome, and to the extent you have any questions or ever have any questions or need help understanding anything, please reach out. That's what we're here to help do. And then also congratulations, Glenn. I look forward to continuing working together. It's been a great experience working with Glenn to try to get these presentations built and make sure we're in the right direction. So that's a great thing to have that leadership, that continuity of leadership, and then same with Chair Philman. So we look forward to working with you folks on behalf of myself and the investment office. But I'll dive right into the presentation on the screen here. And really what it does is goes through the accomplishments of last year and kind of what we want to do for, give you an idea for the next 12 months. And in a broad level, without going through each bullet point, I'd gladly ask questions about them. But what we want to paint at the high level is certainly this is a list of things that got done, but they were all consistent with the mission of paying the benefits. And so what we want to, we know what our mission is, and what we want to see is our accomplishments and our goals align with that mission. And in fact, as you go down through that list, you find that they all did that. I would be happy to answer any questions. So on page 1 there is one list, and if you could advance the slide to page 2, that's the list of accomplishments continued. Are there any questions from the board members on this? Okay, we'll push forward to the goals, because even though you like to celebrate what's been done, normally you're focused on what's in front of you. So let's talk about that a little bit. And again, all these goals are consistent with the mission, transparently fulfilling the asset allocation to achieve the mission, i.e. pay the benefits, right? That's what we're here to do. And in general, what I would say the highlights of some of those things are to review the equity portfolio, which we will do over the next few months, and you'll get a presentation on tomorrow, with the goal of increasing cash flows to help make the benefit payments just that much easier. Review our benefit payment plan to meet what we know to be certain liabilities with certain asset cash flows, right? If we know something's certain, we ought to plan with certainty for it. And so we'll review that, and that'll be a great move in the right direction. We'll also transition the fixed income portfolio to the liability-driven allocation we recently adopted in December. And I really want to try to push on fee transparency. I want to get some of those redactions off of the sheet. As you all read the article, it wouldn't hurt. So that's something that I want to try to make some progress on this year, because transparency is key in all of this. It builds trust, and at the end of the day, all of what we do here to achieve the mission is based on people's ability to trust us. So those are the big goals for the year. Are there any questions on those? Okay, if we can keep this, if you could advance the slide one more, I believe I have one more slide just to show those goals. I wanted to keep it on this slide and talk about a few things real quick. I wanted to give you an update on the fixed income transition. So we've looked at the portfolio and we figure out that we have about, roughly, and these are about numbers, these are approximate, they're not perfect numbers, but about $2 billion of the about $8 billion that we need, or I'm sorry, $9 billion that we need, we have in the portfolio today. That's about 20%. So we can start taking the assets from the old portfolio and putting them in the new structure. And then over the next 18 months, we'll transition the rest. It's about $371 million a month. And we will give you progress reports at each board meeting just to show you that we are in fact progressing and how we're doing toward that goal. But to sort of mute any market impacts, and valuation impacts that can happen over time, we wanted to be careful and cautious with how we went from our starting point to our ending point, and our ending point is much better aligned with our liability. So we need to keep that in mind. Also, as part of this transition, we are going to initiate a search for long maturity credit managers. Callan puts together good data, and you'll see more of this as these managers come forward to you. But what you'll see is that about 75% of the active managers in this space beat the benchmark. And when we start bringing this forward more, I'll explain this phenomenon a little bit better. But the truth of the matter is, if three or your four choices are going to beat the benchmark, then it's probably a safe bet to go ahead and take the active risk. And what you also have to remember is that the fees are reasonably low in this space. You're not going to pay, you're going to pay 20 basis points per year, no incentive fees. So this isn't the high octane active management. We're going to issue that search so that we'll have a group of managers we can bring back to you to fulfill the allocation in this fixed income transition that is dedicated to long credit, the long credit asset. So if you see something hit the trade rags, P&I or whatever, that's what we're doing, and that's why we're doing it. We're looking for active managers because the data says it makes sense to do so, and we're doing it because we're building a fixed income portfolio that better meets our liability. So if you see that stuff, you can link what you see back to what we're doing in this room today. And then the last thing I want to bring up is we completed a rebalancing between the last board meeting and this board meeting. It was roughly about $650 million, and the idea is we sold stocks and bought bonds, right? As the equity market increased, we had to buy more fixed income. If you have any specific questions on the rebalance, I will direct those toward Jim Nolan. So if you have any questions, please let us know, and just know that if it's about the rebalance, I'll direct it toward Jim. Any questions?
Yes.
Yes.
Yeah.
Sorry.
This is Alan. So I'd be curious to know, the investment committee, provided a revised, rebalancing policy during the past year to kind of give the investment office some additional latitude to conduct that rebalancing, especially when things were pretty volatile. Was that authority very helpful to the investment office? Was that something that was, useful during this past year? And, is there some other way in which we should be thinking about our rebalancing policy as well?
For much of the year, Jim was doing that, and to speak for him, I would say yes, it was incredibly helpful having the flexibility to move the portfolio around to meet benefit payments without having to wait, maybe, who knows, 2 months, 3 months in order to get permission to do it is a huge help. And I think the new, the rebalancing policy we have set today, because it's sort of built to do that exact thing from now into perpetuity, is a great step in the right direction as well. I think in terms of the idea of what staff's delegated to do, we could definitely talk about that. There's some things that might make all of our lives easier in the future, but I also understand that's also a pretty sensitive conversation, and I want to make sure we take our time with it. But yes, the authorities that have been granted to staff so far have been incredibly helpful, and I would just turn the microphone over to Jim Nolan to give his 2 cents on how it worked, particularly through the pandemic.
Thanks, Seth. Yes, I echo that as well. Case in point, as we were winding down the year last year, cash had dwindled to a low level below 2%. We had benefit payments coming in front of us, and without any fanfare, we were able to set up a transaction, all low-cost passive index funds, and simply raise the cash. And the other benefit, in addition to being able to meet the benefit payments without any stress whatsoever, it resulted in the exposures for all the public asset classes. Fixed income in particular was below, or capital preservation, including cash, was below target by nearly 6%. After the transaction, like I said, we paid the benefit payments, and the trust sat closer to its target with fixed income and cash still 4.5% below, but that's a good problem because the equity markets continued to rally, which that was a moving target. But just a great outcome. Just put the plan in a better position to achieve the long-term rate of return. Why would you expect to hit your long-term rate of return if you're constantly, significantly away from the target, especially with these markets fluctuating up and down as opposed to just trending in one direction? So it's been an incredibly efficient tool, and appreciate the support you've given us in this. I know we're behind, so if there's any other questions, let me know. If not, we're available offline as well, Seth or I. Thanks.
It's very helpful feedback. Thank you.
Yeah, thanks for the question. Anyone else have questions? Okay, Glenn, unless you think better of it, I'll just turn it over to Callan so he can talk about what they plan on bringing to the discussion this year.
Absolutely. Please.
Okay. Good morning, everyone. This is Tom Shingler from Callan. Hope everyone's doing well. So what we have on the screen is a map of what's been going on over the past year, and then looking to 2021 and what we're doing this year. So to briefly recap 2020, and some of this ties to what we'll be doing, is part of it is the standard monitoring, right? The quarterly performance reporting. We do monthly reporting, all of the monitoring of the managers, everything that goes into that. We went through a fee analysis for the managers, and that's actually a executive session agenda item. So the fee analysis that we've done, we'll be doing that again this year. It's important to do those annual reviews. So we have that as in the executive session. We went through sustainable investing and ESG education last year, and that's a topic that will continue this year. There were other priorities, particularly during the pandemic, in terms of, as Alan mentioned, the rebalancing and granting more authority. We did an education session on that. There were other topics that did take precedent at that time, but we'll be spending more time on that this year. And then did spend a lot of time on fixed income and the structure of that with the new asset allocation. So looking at active versus passive, where it makes sense to potentially use active, going through structure analysis of the portfolio, how to build it, and then getting into some specifics of implementation. So part of that will come to the fore today, where part of the new fixed income structure is having an allocation to high yield, and we have a manager that's being brought before the investment committee today for consideration. And then, as Seth mentioned, with long duration, we did a presentation on that, as did the investment office, and we'll be continuing that implementation this year, including a search for active long credit managers. On the DC side, there was focus on the changes to the plan lineup, and then implementing that on the 457 side, and then looking at the fee benchmarking. So we do fee benchmarking at Cowen for both plan administration and investment management fees. We'll be discussing part of that tomorrow in an education session, and then more at the March retreat meeting. So over the past year or so, we've spent a lot of time with the CSRS investment and finance staff and with Empower on the plan administration fee side of it and improving plan administration. So we'll be talking more about that in an educational capacity tomorrow. Sarah McSurdy is also going to be talking about it in meetings over the next couple of days, and then we'll be coming back in March with some recommendations on that. If we go to the next slide, this is looking at 2021. Some of this I've touched on. A couple other points I hadn't touched on yet. In terms of the fixed income side, I did mention that we're going through implementation of the new structure, Mellon coming before the committee today, and the active long credit search that's coming. On the public equity side, we'll be doing analysis of the public equity structure. Seth will be doing education on that topic tomorrow. And as I said, we will be spending more time on the topic of ESG and sustainability. And then one other point I wanted to mention from a CSRS investment office perspective, we have a meeting on this next month, is we have performance reporting software that we provide to clients, and initially that this was going to be done in person, but because of the pandemic, we decided to delay it, and ultimately, because we've been in this virtual environment for so long, we're moving forward with the installation in the virtual environment so that the CSRS investment office can use this performance reporting software. And then on the defined contribution and DCP plans, so as I said, near term, there is going to be focus on these different types of fees, the plan administration and investment management fees. We're going through benchmarking of that, and then also recommendations with the investment office and Empower on how those fees are paid, the structure of how they're paid, whether it's by the employer or the participant for the plan administration fees. So we'll have education on that tomorrow, as I said, and then more on that in March. And tomorrow, a big project that we'll be presenting is what we call the target date fund suitability analysis. So these plans use the BlackRock LifePath series, and we'll be going through an analysis to demonstrate their suitability for the PA CSRS plans. And that's a topic we'll present tomorrow, and there'll be likely some follow-up on that later this year as well. So that's a brief overview of some of what's been going on over the past year and what we have planned for this year, and happy to take any questions.
And no questions. I guess we can turn it. Tom, do you want to continue on with the performance information?
Sure. Yeah, we can keep moving on. We'll go to the DB and executive summary. Thank you. And I'm going to touch on some key slides here. So if we go to the first market recap slide. Thank you. One more. Thank you. So this is showing the returns for markets for the last quarter of last year and then out all the way to 25 years. And wanted to touch on this to put the returns for PA SERS in context and also to remind everyone how unusual the year was. So we have a visual slide that I think is helpful coming up. But if you think back to where we were in, let's say, March and where the year ended up, I don't think anyone was predicting these types of returns for markets. So if you look at U.S. equities last year, the Russell 3000, that's covering the entire cap spectrum from large cap down to small cap stocks, and that was up almost 21% last year. If you look at non-U.S. markets, the one called the World ex-USA, that's developed non-U.S. markets. It wasn't up as much as U.S. equities, but still 7.6% return. Emerging markets were up over 18%. And also from a fixed income perspective, we saw really strong returns. Barclays aggregate up 7.5%. Long bonds were up even more. And then if you look at all these we have for representing private markets like private equity, you can see the returns were strong. The exception is really real estate. If you think about the impact the pandemic's had on the real estate sector, that's explainable. The good news is that these returns were very did benefit from that in the portfolio. The less good news is that it does mean that our expectations for near-term returns are lower because we have seen in equity markets increases in valuations. We've seen in fixed income markets declines in yields. So it does mean lower expected future returns, and in private markets there are similar challenges. If we go on from here, I'm going to cover a couple more slides on the markets. If you go past page 3, one more. This is showing the U.S. equity market. It's a good visual. So if you remember back in February when markets actually were up for the year, and then we had that very precipitous decline in only about a month down to the trough. So it was peak to trough, negative 34%, and then a recovery through the end of the year where the S&P was up over 18%. And we don't show it here, but what's one factor that supported markets is the extremely accommodative stance of the Federal Reserve and other central banks around the world, as well as government stimulus. So that has encouraged risk-taking in the markets is what we're seeing, and it has supported, particularly with low yields in fixed income, moves into riskier parts of the market. That includes markets we see here as well as markets that we don't track in our regular performance reporting like cryptocurrencies, but it is reflective of an overall theme of when you got this much central support that it does encourage risk-taking in the markets. One more slide on the environment, if we just move from here, is the yield environment. So you may think yields are low in the United States, and they are relative to historical terms, but they are actually, this may surprise folks, they're actually more attractive here than they are in a lot of other parts of the world. So we show here this negative yielding debt index in the trillions of dollars. You can see how much negative yielding debt there is around the world. And positive yielding debt instruments are concentrated more in the United States. So relative to other parts of the market, fixed income in the U.S. remains attractive. And it does present challenges for investors, though, as the tension between the need to have a balance in the portfolio and to have liquidity in the portfolio, as well as to generate return to meet discount rates for public pensions like CSRS. And we're trying to balance those, and that's part of what we've been striving to do with this new fixed income structure, which includes conservative fixed income as well as some more return-seeking components like the Mellon investment that we're proposing today. If we go on from here, I'm going to cover some key slides on the CSRS portfolio. So if you go to on from here, thank you, one more. So this is showing the asset allocation of CSRS versus the target as of the end of last year. This is a snapshot in time, and it does show that the overall asset allocation was very close. So slight deviations by asset class, the most prominent one being private credit, which is a newer asset class, being underweight, but generally speaking, very close to target for all the asset classes. And this is what we want to see, that the risk posture of the portfolio, the actual portfolio, is in line with the targets that the board has approved. If we go to the next slide, please. So this is a good visual to show at a high level what does the portfolio look like in terms of what we could classify as return-seeking assets versus assets we classify as capital preservation assets. And as I said, there are some small deviations by asset class, but you can see the overall risk posture is closely aligned with the targets. So it's important to have that capital preservation component, and also given the discount rate, there is the need to take risk in the portfolio. So we do see that the balance is very closely aligned with the agreed upon asset allocation. If we go to the next slide, this is a slide that we've started to include looking at projected risk and liquidity and correlation of the portfolio. So we bucket these assets into the capital preservation bucket versus the return-seeking bucket, and then we look at how it correlates to equity. So what are its diversification properties is what that really means. And you can see the capital preservation assets do have diversification benefits to them if they're lower returning. And the return-seeking assets, they correlate more to each other, to equity-like investments, but they provide potential return. And what's also important to see here, and Seth's going to talk about this more tomorrow in terms of generating income for the portfolio, you can see there is a good amount of liquidity in the portfolio coming from the capital preservation assets. So we look at the months of benefit payments with the CSRS Investment Office, with the help of Jeff Meyer and his team, looking at months of benefit payments if you don't even account for contributions, and then if you do account for the employer and employee contributions, and what those cumulative months of benefit payments are that the portfolio can generate. So it does show that there is liquidity in the portfolio. If we go on from here, one more, please. Thank you. I'm going to cover performance here for the recent past and then the longer history. So it was a very strong fourth quarter. If you look at these high-level numbers, the CSRS DB plan had a 10.44% return versus a target of 9.23, and the manager effect, so the asset classes are structured and the active managers, that did benefit the portfolio. So you can see added additions from that relative to the target return. So overall, this was a very strong quarter for the portfolio. So this is part of the rebound that we saw last year coming out of the trough in the early days of the pandemic. And the outperformance was broad. So if you look at different asset classes, really they all contributed. Red line there for the asset classes was legacy hedge funds, and that's a de minimis dollar amount at this point. If we go to the next slide, this is the 1 year performance, and the absolute return was very strong, over 12% for the plan, and then that did underperform the target, so that was not manager effect. It was driven by deviations in asset allocation given the volatility that we saw last year. So that's what drove that relative underperformance, but the total fund return on an absolute basis was very strong. And you can see generally speaking, the active managers did very well. If we look at the manager effect was positive at 65 basis points. So overall, this was a very good year for the SERS portfolio. And if we go one more slide, please. This puts in more context. 1 year, if we think about an infinite life public pension plan, 1 year is really nothing in the big scheme of things. And we're showing out to 20 years here, and you can see the performance of the SERS portfolio versus a public market benchmark, so just stocks and bonds, and then versus the benchmark of the asset classes SERS is actually invested in. And generally speaking, the SERS portfolio, the long-term returns are above median, and then when you go out to the longer period, all the way out to 20 years, you can see it's in the top quartile. And this is Cowen's public fund peer group that are 10 billion plus peers. So this is a comparable peer group for SERS, and this includes over 40 plans. And the last slide I'll cover is on 16. This is where we adjust the asset allocation of the other plans that are in this database, this peer group, to have the same asset allocation as SERS. And you can see that the adjusted rankings for asset allocation actually improve. So that shows that in these time periods that we have, adjusted rankings are slightly better. So that shows a positive implementation relative to the broad asset allocation non-adjusted rankings. So where it's driven partly by asset allocation and partly by implementation. This is more of a look at it purely by implementation. So I'll stop there in the interest of time. I know we have a lot more to cover, and see if there's any questions on the DB plan. I see Alan Flanagan.
Yeah, just quick comment. I mean, this slide really shows the very positive, performance of staff and great skill in implementing the asset allocation that the board's approved, and doing it for several years on end now. So, just wanted to kind of highlight that and express some appreciation to staff for that. That's, really terrific work.
Thanks, Alan. We appreciate that.
Okay, can we move to DC plans?
Yes, sorry. Unless Glenn has another idea, I'd say we just keep rolling.
No, I would keep rolling, please. Thank you.
Okay, great. My name is Bud Pilecchia, and I'm also with Callan, and I'm going to cover the Deferred Comp 457 plan. Since Tom went over the capital markets for the quarter and for the year, I'm just going to skip ahead to page 7, please, and just give you some insight into what our clients are thinking about when it comes to defined contribution plans, what they're focusing on. So this is a survey that Callan consultants take on a quarterly basis, asking us what are the most important topics for your DC clients. And you can see there that fees are a top concern for sponsors, really for the last 5 years. That's followed by investment structure, compliance, and then participant communication. So fees continue to be a very strong interest of all of our clients. At the bottom of the page, there was a number of questions this quarter around ESG. About 17% of our clients have an ESG option in their plan, and about 52% have never even discussed the topic. In the middle there, you see that some, 10% or less, are either asking questions, due diligence questions of their managers, potentially having something written in their investment policy statement or on investment beliefs, or they're actually now considering adding an option to the plan. So we just thought you might be interested in seeing some of those topics that are of concern to our clients. If you turn to page 8, The next couple of pages have some trends in the defined contribution industry. One of the big trends is consolidation continues around record keeping. Vanguard announced a partnership with InfoSystems in July, and Empower announced its acquisition of Mass Mutual towards the end of the year. Also, the IRS announced updated retirement plan limits for 2021, and those are listed in the middle there. And then also the DOL issued its final rule on what type of factors can be used when choosing an investment option. Focus was on retirement of fiduciaries to evaluate only pecuniary or financial considerations. However, though, as Tom discussed during the ESG education, it is anticipated that the new administration is going to take a fresh look at this, and it's very well may be altered or changed going forward. On page 9, a similar related DOL rule that they issued a final rule for fiduciary duties in voting proxies held by ERISA plans. The key takeaway was that the fiduciary must consider the financial significance in voting or not voting the proxy. But again, here, it's expected that the new administration is going to take a fresh look at this, and it very well may be altered as well. There's also proposed new retirement legislation, the Secure Act 2.0. While it's still pending, we highlight some proposed changes, including allowing for matching contributions for employees who are still repaying student loans, and also increasing the catch-up amount to $10,000 for those over 60. And then finally, every year for the last 14 years, Callan has been sponsoring a DC Trends survey for our clients, and that was recently published earlier this month, and we're hosting a webinar later this week on the 25th to go over that survey. So we encourage you all to join if you can. It's a webinar that'll be done virtually. If we move now to your plan, going to page 11, here is a look at the current asset allocation as of December 31 on the left, and then where the recent contributions came into. So on the asset allocation side, U.S. large cap and stable value are the top areas of allocations, followed by the retirement date funds, and then SMID cap U.S. equity. Similarly, on the contributions, the contributions are flowing mainly into the stable value fund, to U.S. large cap, to the U.S. SMID cap, and to the retirement date funds. The next page just has the assets and the growth from September 30th to December 31. Strong investment return up over $350,000, but there was a net negative investment dollar amount of $19,200. Total assets are $4.3 million as of the end of the year. Turning to page 13, this is looking at the change in market values as well as the contributions. So it's a combination of all three of those factors: investment returns, participant contributions, employer matches, withdrawals, and then transfer between funds. And again, the top areas are U.S. small and mid cap, as well as U.S. large cap, and then the retirement date funds had the biggest increases. The bottom of page 13 reflects the historical allocations of contributions quarter by quarter going back to beginning of 2019. So that's just a graphic of showing the pie chart from the previous page, but on a historical basis. Page 14 reflects the BlackRock LifePath Retirement Fund's glide path. So if you look at the bottom chart, the line at the top of the shaded area reflects BlackRock's roll down of equity exposure. So their exposure to equities and equity-like investments are higher than the median and near the top of the peer group for a good portion of the roll down period. It does go below the peers, the median, as you get closer to retirement. But for the retirement date funds that are far from retirement, they have a good amount of equity and equity-like exposure. And that does reflect in the performance that we'll look at on page 19. I think it's the easiest way to look at that. So on page 19, these are the stoplight pages that reflect, if it's in green, it means that it's above median for the period. If it's in yellow, it's in the third quartile. And if it's in red, it's in the fourth quartile. Most of the performance for the retirement date funds, the glide path funds, are in the green. There are some areas where it's below median. These are all managed passively. So although there are a number of different asset classes within the retirement date funds, they're all managed passively. And they're all doing a good job of mimicking the performance or closely matching the performance of the index. So they're index funds that are tracking very closely to the index.
Hey, Bud, if I could just add one thing, just for a reminder, is that in this space, much of it is passive, and the differences between funds are based on how these asset allocations are constructed. To your previous point about the amount of equity in each one, that's probably the biggest driver of our differences between what we provide and what others provide.
That's right, Seth. On the far right is the expense ratios for all of these funds are at 8 basis points, which is extremely low fee compared to the universe, both for those funds that are active as well as those that are passively managed. Page 20 has a continuation. Now we're looking at some of the standalone funds after the retirement date funds. So we have the domestic equity, a large cap fund managed against the S&P 500, and a SMID cap fund managed against the Dow Jones U.S. completion. You can see that they're mainly all in the green, reflecting strong performance from passively managed accounts in U.S. equity. And then moving down to fixed income, the short-term investment fund is tracking very closely to the 3-month Treasury bill. It doesn't rank as highly in this peer group. We've talked about this before. It's just because the peer group includes a lot of other retail-oriented cash accounts that have different guidelines than what you're being managed to. So it's a little bit of a tough competitive comparison. And the stable value fund is doing extremely well. We'll take a closer look at that in a minute. And then the U.S. bond fund, which is managed against the Bloomberg Aggregate Index, that's tracking that benchmark very closely. It does show a lot of red, just reflecting that active management in U.S. fixed income tends to outperform the index over time. But the purpose of this fund is to give you broad exposure to U.S. fixed income and track the benchmark, which is doing very nicely. The next page, page 21, shows you how strong the stable value fund is compared to its competitors. And it's in the top quartile, near the top decile, basically for all the years shown back to 10 years back. That concludes the comments on the deferred comp plan. Happy to take any questions, or we'll turn it over to Britt for the DC plan.
Thanks, Bud.
Sure.
Questions? I do not see any. So, Britt, floor is yours.
Great, thanks, Seth. In the interest of time, if we can jump to page 11, given that Tom covered the market environment, but covered some of the DC industry trends. The 401A plan at the end of December, you can see the asset allocation on the left. 90% of the plan's assets were in the target date funds, followed by U.S. equity funds, non-U.S. equity funds. And consistent with the asset allocation, you can see participant contributions have been allocated very similarly, and that is due to the retirement funds being the default investment for participants going into the plan. We turn ahead to page 12. We show the asset distribution as of December 31st. You can see this relatively new plan up to almost 35 million in assets. You can see about 6.1 million in new contributions and about 3.7 million in investment gains during the quarter. On page 13, just highlight the change in market values. As you might expect, with over 90% of the contributions going to target date funds, the target date funds also grew significantly more than the other options, and they have done so, as you can see in the bottom chart, historically since the plan was started. Turning ahead to page 15, I won't lament on target date fund performance, as Bud just touched on it, but you can see here over the quarter, strong absolute performance, 6.77% for the post-retirement fund, up to about 15.13% for some of the longer dated funds. So extremely good performance. And you can see over the 1, 3, and 5 years, the target date funds are tracking their index well and rank competitively versus peers. Turn ahead to page 17, just highlighting the individual investment options within the plan. And again, given the passive nature of these funds, they continue to track their indices adequately with limited tracking error, and you can see strong absolute performance for all the equity funds and strong performance for the fixed income funds that they're tracking their index closely. On slide 19, just want to highlight and reemphasize the expense ratios on the far right. Again, the target date funds all in the cheapest quartile, cheapest decile of peers, so very competitive. And on slide 20, showing the expense ratios of the individual investment options, and again, all extremely cheap options for participants that rank extremely competitively versus peers. I will pause there in the interest of time. I know we have a lot to go through. Happy to answer any questions on the 401A plan.
Okay, if there are no questions, I'm going to break in for just a very brief administrative issue, if I could, and then we'll get right back onto the regular agenda. We had just a slight change to make to the motion that was adopted for the what was it, the committee charter, maybe. Sorry, totally lost my train of thought. The committee charter. We just have to make a slight change, and what I would like to have the motion amended to provide for the involvement of the Board Governance and Personnel Committee in the review process. Accordingly, I move to amend the previous motion to recommend, 1, to the State Employees Retirement Board that it approve the amendments to the Investment Committee Charter as set forth in the attached after receiving input from the Board Governance and Personnel Committee, and 2, to the Board Governance and Personnel Committee that it concurs with this committee's recommendation and so inform the State Employees Retirement Board. May I have a motion, please?
Philman moved.
Thank you. May I have a second, please?
Second, Jordan.
Thank you. Could we have a roll call vote, please, Jim?
Okay. You're up, Mr. Becker.
Yes.
And Mr. DeSanto, Senator DeSanto.
Aye.
Thank you. Chair Philman.
Aye.
Representative Frankel.
Aye.
Treasurer Garrity.
Aye.
Ms. Marchowski, on behalf of Senator Hughes.
Aye.
Mr. Jordan.
Aye.
Mr. Fall.
Aye.
And Mr. Flanagan, on behalf of Secretary Vag.
Aye.
Okay, you have unanimous again. Mr. Becker, thank you.
Okay, thank you, Jim. So the motion passes, and sorry for that interruption, but all the T's are crossed and the I's are dotted now. So I'll turn it back to Seth.
I do see a question, although he put his hand down. Senator, do you have a question, Senator DeSanto?
Yeah, I just wanted to just take a moment to comment after the Callahan presentations. You know, overall, excuse me, you know, the past year, our funds returned 12.01% gross of fees and 11.1% net of fees. But we have to acknowledge that this return was 1.49% below our benchmark, which translates into a $500 million underperformance of the fund. And I'm just bringing that to light because we sent out a press release earlier in the week or late last week, you know, saying that we hit 11% overall. And in fact, that's true, but it's under our goal. And I think in the interest of transparency is, you know, Seth was talking about and, you know, trying to be forthright with our stakeholders. It's just important that we acknowledge the context of where we're at here with this. It's been a very tough year. We've done a lot of work. And we did hit 11%, and that's probably very laudable, but, you know, it's really under what our goal was. And I just think we should be more transparent on the press release there. So I just as a comment, thank you.
No, we appreciate that. And in fact, you are correct that it is under the benchmark, and we'll consider that for the next iteration. And you know, not a point of pride, but you know, there are explanations, and as I look down through the benchmarks, we can probably do a little better job of making sure the risk that we have invested matches the benchmark. And I think that a lot of what you recognize in that you know, underperformance is in fact that. So hopefully over the next year we can clean some of that up and make the return comparisons much more apples to apples.
No, I agree, and I'm not trying to beat you up or the team unnecessarily. I just think it's important that we are transparent with the people that we're communicating with, our stakeholders, the beneficiaries. And we did hit 11%, and that's probably, as I said, laudable, but we need to just keep the context within transparency so people don't come back to us in a public format and go, oh, yeah, you hit 11, but you were supposed to hit 13. If we bring that information out forthright, I just think it's better for all of us and our beneficiaries. That's all.
No, I agree. It is what it is. It's a fact you can't hide from, and you just need to answer it. So, and work to do better, which we are. And I guess the nice part or the bad part about my job is that you have to give me a little time for it to work. So I could say, just it'll work. Just give me a few more years or decades. If you got them, give me decades.
Well, Seth, look, I'm not blaming you. This is just a communication issue, I believe, and I've said the 11% is probably, it's not what we wanted, but with the year that we've gone through, it's probably it's a good outcome, I guess, with turbulent financial markets. The point I'm trying to make is we need to be honest and transparent with our communications to the public. Let's just lay it out. We're doing a good job, and we'll continue to strive to do better. That's all. It's not a personal attack or judgment on your performance.
Point taken, and we will do that in the future. It's not a hard sentence to add. We can simply just add the comparison to the benchmark. So have I addressed your question or comment?
Yeah, we're good. Thank you.
Okay. Then what we'll do is move on to the agenda item I, which is the private equity opportunity we have for Hellman Friedman. If I'm seeing somebody is waiting in the lobby right in the middle of my screen. I don't know if that's something everybody's seeing, but so one of the things I want to start with before I toss it over to Dave Felix, who will describe, who will introduce the manager, and the manager will then introduce the strategy. When we think about private equity, I want to start at the top level, and we can work down to the specifics of Hellman Friedman. But at the top level, when we think about what we need to do with our private equity portfolio, the way we have it modeled within our underwriting system is that we need to earn 20% more than the comparable public benchmark. Okay, that's the goal. That's what we need to strive for. Hellman Friedman is an existing manager. In fact, they've done that by my analysis that just looks at multiples of cash flow. Had we invested in the passive public markets in the same way we gave cash to Hellman Friedman over time and in all their funds, we would have multiplied our capital by 6.9 times. That's pretty impressive. That's just the public markets. There's no special value added there, right? That's just call up Vanguard, buy the index, and shut the light off, right? So by investing in Hellman and Friedman, we were able to multiply our capital by 8.4 times, which is about a 22% premium. Hellman Friedman is unequivocally a top quartile manager. And it takes that top quartile performance to hit our mark. So this really shows the importance of the work that Dave Felix does with Stepstone. Because if we don't invest in these top quartile managers, then it's very difficult to hit that bogey. Fortunately for us today, we're sitting in front of a manager who has done that for us. So Dave, I will turn it over to you and to carry on the conversation.
Thank you, Seth. Today we are presenting Hellman Friedman Capital Partners 10. The Fund 10 is targeting a fund size of $20 billion. This is a long-standing relationship for SIRS, as Seth mentioned, going back to Fund 2, and a general partner that I've personally known for nearly 20 years. As a side note, the general partner is very transparent and has increased their diversity efforts, which you'll hear more about. Hellman Friedman is a top-tier global buyout manager investing in large buyouts in North America and Europe. The fund will target equity investments of between $400 million to $4 billion in companies with enterprise values between $1 billion and $10 billion. The fund will target companies across multiple sectors, including business services, software, and financial services, to name a few, building a portfolio of approximately 15 portfolio companies. AHNF has a very experienced and deep team, an outstanding track record spanning over 30 years with a very low loss ratio. The terms for this fund are in market with a very strong GP alignment commitment. We are recommending a commitment on behalf of SIRS of up to $125 million to Fund 10. I'll have Mike Elio from Stepstone provide some brief commentary and their GP conviction level.
Sure, thanks, Dave. As Seth mentioned earlier, staff and Stepstone did a commendable job deploying over $700 million in commitments to some high conviction managers. Starting off this year with Hellman and Friedman is really a continuation of the work done in 2020, continuing into 2021. Hellman and Friedman is one of the longest standing high conviction managers that Stepstone has had in this particular market segment through market cycles. To put this in perspective, they have been a very strong partner to PA SIRS. You've deployed $400 million to them since you've been partnering with them over the years. They've returned that capital and an additional $350 million on top of it, and you still have about 100 million in NAV invested with them. They are a single fund firm. As they have grown, they have not grown their platform to distract their platform into other strategies. They're focused, and they have a huge GP commitment to show an alignment of interest with their investors. I will not go into too much detail. They're here to give a presentation, so hopefully they're not on the line yet to hear me say good things about them. But at this point, I guess, Dave, will pass it on to the GP.
Right. Alan and Zita, you could take it from here.
Great. Hi. Thank you very much for having us. Let us introduce ourselves quickly, and then we'll get into a few pages here to go through with you. I'm Alan Thorpe. I'm a partner at Hellman & Friedman. I've been at Hellman & Friedman for 22 years. I sit on our investment committee, run our New York office, and lead our healthcare and financial services investing. Zita?
Hello, everybody. My name is Zita Sorrell. I'm a partner in our London office. I joined the firm about 15 years ago as an associate, and I've made my career at H&F. I lead investments across Europe in a couple different verticals. And in addition to my investment responsibilities, I spearhead our ESG efforts globally.
So thanks for having us. We appreciate the chance to be here. I'm sorry I couldn't visit with you in Harrisburg like I have the last couple of times that we've come and talked to you. And I'm even sadder, my 4 sons are even sadder that we didn't get to Pittsburgh this fall. They are rabid Steelers fans, and the fall Pittsburgh pilgrimage is part of our family tradition that we couldn't do for COVID. So we're thrilled to be here. Thank you for having us, and we've appreciated your long-term partnership and support immensely. So let me start on the pages. If you could flip the page, please. Let's go a few more to through the disclaimers. There you go. So just a summary, I know you know maybe a lot about us from the history. Hellman & Friedman has been at this a long time. We've been investing since 1984. We have a very unique strategy in that we're only doing one thing. We're concentrating our efforts in large-scale buyout investing. That is control investing. That is minority investing. We've done a range of those things, but we have one strategy. We have a concentrated strategy. We think of it as a best ideas fund, where our job is to go and scour the world and work hard to get a small number of very high conviction bets. We're not in the triples and home runs business. We certainly love it when we have one of those things, and we've had several, but what we're trying to do is singles and doubles, high quality investing with high quality returns in a small number of portfolio companies where we have great conviction. We do this in sectors. We try to be very deep in our sectors. We're experts in our sectors. And we do it with a stable team who's been here for a long time. You have a high level of longevity. You have a high degree of internal development and promotion. We think that's really important when you're trying to create an investment organization. So we have a level of continuity and longevity, which hopefully helps us make better decisions. The general partner is highly aligned with you. So we as a general partner, when we make an investment, that's not a moment for us to take fees or to accrue fees. That's a moment for us to write a check alongside you. So we personally, as a general partner, investing over $1 billion in this fund, and that's been consistent in our last few funds. And you know, we're a small owner-operated firm. We're alongside with you, and we're aligned with our LPs in every way. So our track record, over a long period of time, we've had a gross 30% IRR, net 22, gross 2.7 times, and net 2.2 times, with very few losses. Again, we're not trying to make a wide range of very high risk bets. We're trying to do the opposite: few concentrated, high quality bets. Next page, please. So just in terms of the markets where we spend our time, you heard these alluded to a little bit. We're trying to write $400 million to $4 billion target equity checks. We think that portfolio, that will end up with something in the teens number of portfolio companies in this fund that we're currently raising. These are some of the sectors where we've been most active. And over time, it's been our job, and what we've really focused on is developing our intellectual property, being able to push the envelope of different types of areas,
where we have expertise and we feel comfortable going and evaluating companies, assessing companies, and then driving performance in those companies. These are some of the sectors and some of the spaces where you would see us be most active historically, and we would expect into the future for these to continue to be our big vertical markets. Next page, please. So again, our returns over the last 30 years, you can see there are a couple hallmarks of this. Number one is consistency of performance as our fund size has increased. We, for a long time, have been spending time on large companies. This size company that we're spending time on today and looking to invest in is very similar to the size of company that we've invested in the past. And in fact, our portfolio today is filled with a number of companies in the 10 to 15 to $20 billion enterprise value range where we have very large positions. So that's the world that we play in, and we're incredibly accustomed to it. And you can see how these returns have evolved over time for each of the funds. And, you know, we think about things only on a realized basis. So these are all these are mark to market, but of course we only get paid and we only think about the final tally comes when we ultimately get liquidity on a business. Next page, please. So this is our team. You can see the particular names and faces. The key point to emphasize here, we are in 3 offices. We're in San Francisco, New York, and London. As you heard, I run the New York office. Zita's in our London office. Our headquarters is in San Francisco. That's where the bulk of our people are, but we have quite big New York and London offices. And again, I'd characterize this by a high degree of longevity among our people, and a high degree of consistency. And most of our partners would have been internally grown and nurtured and developed at the firm, and we think that's really important for culture and investment philosophy maintenance. So with that, why don't I turn it over to Zita, who will add a few things on ESG and diversity.
Thank you, Alan. So over the next couple slides, I'm going to give you a flavor for how we incorporate ESG into our investing practices and talk a little bit about our diversity, equity, and inclusion initiatives. So I want to start with what ESG means to us as an organization. You know, from our perspective, ESG is embedded in everything that we do. It's simply put, doing business the right way, building sustainable businesses. And sustainable businesses are the key to sustainable returns for everyone. So with this foundation principle, what we're really focused on is continuous improvement, getting better at ESG in our governance. And this slide lays out our progression. So you can see we started with risk management. We then moved to building topic-based platform. And from this year, we're taking a customized approach by company. So rather than a generic portfolio-wide KPIs, we're looking at the specific ESG factors at each and every company. And we believe that this customized approach is going to enable us to be more effective at driving change and better outcomes for the companies and for you, our investors. You know, we've also chosen to double down on diversity, equity, and inclusion as a key focus area for us across the portfolio and at the GP. And it's a natural focus area for us. You know, we invest, as Alan showed on that slide, we invest in people-led businesses. Through our portfolio, we employ 150,000 people. And we're clear that talent is everything. You know, we believe that diversity supports an engaged and motivated culture. You know, it improves decision-making, it drives innovation, and it helps produce sustainable businesses and superior returns. And so we're very clear that our success and that your success rests on attracting and retaining and engaging those 150,000 people. If you could flip to the next slide, please. So on this page, we've set out, you know, at a high level, all the initiatives that we have at the portfolio and at the GP to help foster improved diversity, equity, and inclusion. And it's a journey of continuous improvement. There are quite a lot of different things on this slide. You know, we, at our portfolio companies for a number of years, have been hosting a women's leadership summit to help develop the next generation of female leaders and board members. We monitor diversity and equity and inclusion KPIs at our companies to help them on their journey, and we support chief diversity offers in their work at the company's levels. What I want to particularly highlight today is our gender diverse board initiatives. So that first bullet there. We believe in setting a tone from the top, and I wanted to give you some updated statistics versus the diligence materials we've shared. So in February 2020, we set out to improve the gender diversity of our boards. And in the span of 12 months, all of our companies but 3 have at least 1 female director on the board, and many have more than that. Diverse directors, be that gender or ethnicity, now make up 20% of board positions, up from under 10% the same time last year. So we're making progress. There's still a lot of room to go, and we're committed to continuous improvement, but I think that helps highlight just how focused we are on moving the needle forward. So with that, I'll hand it back to you, Alan.
Okay, great. So thank you. I think that that concludes the slides that we wanted to go through, and we're happy to open it up to questions.
Does anyone have any questions for Hellman and Friedman? I do not see any. So I'll turn it over to Glenn to go ahead and make the motion.
Glenn, you're on mute.
Okay, Seth, we'll sign off, but thank you very much. We appreciate staff support and the whole plans partnership over this long period of time. We really appreciate it.
Well, thank you for coming today, and we appreciate your time.
Thanks.
Hello, Seth?
Yes, Glenn. Yeah, I think
we're
we're
the motion. I've been having some technical issues here, but
are we
ready are we ready for the motion at this point?
Yes, sir.
Okay, I apologize for that. A motion is in order to recommend that the State Employees Retirement Board commit up to $125 million to Hellman and Friedman Capital Partners 10 LP, plus investment expenses and pro rata share of partnership operating expenses consistent with executed partnership documents as a follow-on investment within the private equity asset class, subject to successful completion of contract negotiations and execution and delivery of closing documents by all parties, including required Commonwealth legal approvals within 12 months. May I have a motion, please?
So moved, Philman.
Thank you. May I have a second?
Second, Frankel.
Okay. We have a motion. It's been seconded. May we have a roll call vote, please? Jim Nolan?
Okay, starting with you, Mr. Becker.
Aye.
Senator DeSanto.
Aye.
Chair Philman.
Aye.
Representative Frankel.
Aye.
Treasurer Garrity.
I want to let you know why. It's because the investment has a distribution structure that also utilize party administrator and
I'm having trouble hearing that.
Yeah, we couldn't hear you.
Couldn't hear any of it.
Okay, I hope you can hear me now.
Yes.
Yes, ma'am, we can.
Okay. I am going to vote no, and I wanted to just briefly tell you why. It's because the investment has a distribution structure without a preferred return that Stepstone would describe as general partner favorable, and H&F doesn't utilize a third-party administrator or have an internal audit function. Thank you.
Okay, thank you. Ms. Marchowski, on behalf of Senator Hughes.
Aye.
Is everybody on mute?
I think it's Greg waiting for his name, Jim.
Aye.
Mr. Thal.
Aye.
And finally, Mr. Flanagan for Secretary Vag.
Aye.
Thank you. We have one no, all yays other than that, Mr. Becker.
Okay, thank you, Jim. Okay, so by a vote of 8 ayes and 1 no, the motion is passed. Thank you very much.
Okay.
Seth, we'll turn it back to you, please.
Yes. So we'll go down to item J, which is the Mellon High Yield Fixed Income Enhanced Index. So if you could just advance one slide, I'll spend all the time on this particular slide. It's a table of numbers, which I need my glasses to read. And so I kind of want to walk you through this table of numbers. I think some of you will know, and for those who don't, I'm a very data-oriented person. Mathematics is my background, and so when I look at investments, I tend to look at it through a statistical lens first, because data doesn't lie, only inferences can lie. So when I look at this data, one of the things we set out for with high yield, remember it's part of our new fixed income structure to generate a higher yield so that we can more easily pay benefits, right? So that's the reason for this investment. When we looked at the data, different from long credit, what the data in this was Callan's data that Tom shared, what the data in high yield said is taking active management was a coin flip. And so when I've got a coin flip of beating the market, I don't take that risk. You just own the market cheaply and have more assurance that in fact you'll get the return you want. So as we started looking for indexes, the one thing that we noticed is, and I'll pull your eyes down to, in the top box, the little section that says investable high yield proxy return. So I'm going to focus on that. So this was an option we could use to, invest passively, low fee, index, all of these things that we talk about. And if you can look at each of the year columns. And if I want to take you all the way down to the last row that says tracking error under the investable high yield proxy return section. Tracking error is a measure of difference in the investment we own versus the benchmark. So high levels of tracking error suggest high differences from the benchmark. And in general, when you kind of think about what a normal tracking error would be, say put that on the order of somewhere between 2 and 4% given the strategy. So when you see these tracking errors of 0.81, 0.54, 0.52, those are still reasonably low tracking errors. But the trick here is that that's a benchmark that you wouldn't. So what that's telling you is to invest in the benchmark within high yield. You can't do it perfectly like you can with the S&P 500, which has a very low tracking error, almost zero, basically. And so what you're looking at there is you say, okay, well, I've got to take some tracking error. I've got to be different from the benchmark to even invest passively. So then what got brought to us smartly, I think, by Callan was this Mellon strategy. And what Mellon, and by the way, you'll notice I want to go back to the investable high yield proxy return before I leave this section. You'll also notice that thing that says excess return, BPS, which is basis points. So you can see those negative lines in front of there. That's not good. That's not what we want, right? We don't want to lose money relative to the benchmark, and that is exactly what that column is telling us. So we have to take tracking error, and it's telling us that we might lose money doing it. So now I want to take you up to the Mellon high yield beta return. So they showed us this. It's like, well, okay, we have to take tracking error. Let's look at what we have that we can take some tracking error with that might make some sense, but still be very close to the benchmark. And I'll prove the close to the benchmark point in the lower table, but I want to hit this point real quick. So in the Mellon high yield beta return, if you look at that tracking error line, you can see those tracking errors are closer to zero than even the passive benchmark. So then you're sitting there going, well, geez, they're closer to the index than the best benchmark, And when you look at the excess return, they're positive. Doesn't mean they'll always be positive, but you know you have to take tracking error, and the index has done nothing but lose you money with that tracking error. What this Mellon thing does is seems to take less tracking error and at least gives me the ability to make a little or break even. So hit the benchmark return the way it should be hit. So that's appealing. I think we can all sit down and say, that makes sense. If you're in the course of a decision-making process and you see these data and you say, okay, well let's go about figuring out how we can see if these people are really doing the great stuff that the numbers show. And I'll also point out, if you look at the Mellon high yield return, the line below it says BB US high yield return. BB is for Bloomberg. Look at how close those returns are to each other. So they're very close. They're like the index. And to further prove that, I'll take your eyes down to the bottom table. So the risk metric, a common risk metric used in investments is beta. For some reason, investments just really loves Greek things. But in statistics, beta is the slope of a linear regression, and alpha is the intercept. So you can take all this math that I learned and you can apply it to these sorts of problems. So what it shows is, across, if you look at the Mellon high yield strategy and you look at that beta line on the lowest table, you see that beta is around 1. The importance of that is if you perfectly invest to match the market, the beta will be 1. That is perfectly matching the benchmark, right? You have the same risk profile. So you can see a beta of 1.01 within reason has the same risk profile as the benchmark, and that's the 1-year number. But I'll also compare it to the best investable high yield proxy, which doesn't have a perfect beta of 1 for the reasons we discussed above. So then I say, well, that's fine, statistics are crazy, but how significant is this statistic in the context of a math hypothesis problem? And that's where I want to point your eyes to the p-values on the beta line of Mellon. P-values near 0 suggest that this is an extremely significant outcome, almost beyond doubt is what that's telling you, that these people are high yield investors, no doubt. And so you can see that those p-values are 0 for high yield, or Mellon high yield, and you can see those p-values are 0 for the investable high yield proxy. So by choosing either one of these things, we are investing in high yield, no doubt. And then you can also show this by the R-squareds. R-squareds have a cap of 1. If your R-squared is 1, it means you perfectly match the benchmark, both from a up and down movement standpoint and a magnitude standpoint. So it's a very, very similar investment to the benchmark. And with the alphas, none of them are statistically significant. But at least with Mellon, I have the opportunity where that tracking error doesn't cause me negative return, which is what we've seen out of the benchmark. So as I sat here with this table in front of me with a math mind, that's how I came to the conclusion that in what we're trying to do here, Mellon made a ton of sense. And so then, of course, there was a lot of work done both by Callan and staff to understand exactly what Mellon was doing. And really what they're trying to do is hit the benchmark, but try to do it as efficiently as possible and take some smart risks around the edges. But overall, the driving force is to get the benchmark. And we brought this to you, if you'll remember, we brought this to you, you gave us permission to hire passive mandates to implement the fixed income portfolio. As I've shown you with the math, this is a passive mandate. I mean, they say they're an enhanced index, so they market themselves as something other than purely passive. So out of an abundance of caution, I brought this forward. But the reason we want to put this in the benchmark is to serve the need of the high yield component in a benchmark way. And these statistics prove that it happens. So I'll be quiet here, and then I'll turn it over for questions in terms of the detail of the strategy. And I would point toward Bill Trong and Callan to help provide insight on those questions. So please, question away. Did I bore you all with the math? Was that the thing? I led with the math, and then the question, like, I can't ask questions now. Is that what it was? It's a good tool. I'll have to remember that. But not seeing any questions, I'll turn it back over to Glenn for a motion.
Okay. A motion is in order to recommend that the State Employees Retirement Board approve an investment of up to $500 million to the BNYM Mellon DBSL High Yield Beta Fund as an investment within the fixed income asset class, subject to successful completion of contract negotiations and execution and delivery of closing documents by all parties, including required Commonwealth legal approvals within 12 months. May I have a motion, please?
Yes, this is Alan.
Okay, Alan, thank you. May I have a second, please?
Second, Philman.
Thank you. Okay, we have a motion. We have a second. Jim, may we have a roll call vote, please?
Yes, Mr. Becker, we'll start with you.
Aye.
Thank you. Senator DeSanto.
Aye.
Thank you. Chair Philman.
Aye.
Thank you. Representative Frankel.
Aye.
Treasurer Garrity.
Aye.
Thank you. Ms. Marchowski on behalf of Senator Hughes.
Aye.
Mr. Jordan.
Aye.
Thank you. Mr. Thal.
Aye.
Thank you. And Mr. Flanagan on behalf of Secretary Begg.
Aye.
Thank you. That's unanimous, Glenn.
Okay, thank you, Jim. So by unanimous vote, the motion passes. Thank you.
Thanks, Glenn. I will say also that we were able to get almost benchmark fees from this manager too. So we're getting this product at basically what we would have paid for a passive mandate. And so the whole thing works out. I think on the investment, it averaged to something like 13.5 basis points. So you can tell this is not high fee stuff. This is right down the fairway of passive performance. But thank you for that vote and for the support. So we can head to the next item. I think, would that be item I? No. K.
Okay.
So what we have with item K is the need to extend the Stepstone contract. What I will say is that we are happy with Stepstone and the relationship. And Mike and all his team. They are deeply involved in our decision-making process, and the SIRS and the Stepstone team work together to try to develop the proper diligence processes for these managers, basically liquid managers, private equity, private credit. So they are critically important to how we do this. And as I mentioned earlier with Hellman and Friedman, it's a tough game to get top quartile managers because we got to get 20% above the benchmark. And really, when you look at the market, the way you do that is with top quartile managers. So it's having a cohesive and continuous team is critically important. They also aren't increasing our fees. And I think that a change right now would be detrimental to what we have going on. We would have to focus on building a new diligence process with the new consultant, and that would be difficult. And quite frankly, as you'll see tomorrow, and as I'll talk about in just a few minutes, our focus should be on trying to get the benefit payment as secure as possible, and then we can kind of figure other stuff out on the backside. But that's goal number one. And right now, when you think about the payment of that benefit, Stepstone is absolutely accretive to that effort. So we need you to approve a extension of the current contract so we can keep doing the good work we have been doing. Are there any questions about this topic at all? No hands.
Okay, seeing no hands, I guess we'll move to a motion. So a motion is in order to recommend that the State Employees Retirement Board authorize an extension of the agreement between SERS and Stepstone Group LLC for private equity consulting services for 18 months until October 4, 2022, under the existing terms, services, and fee schedules, subject to successful completion and contract negotiations and execution and delivery of closing documents by all parties, including required Commonwealth legal approvals prior to its expiration. May I have a motion, please?
So moved, Philman.
Thank you. May I have a second, please?
Second, Greg Thal.
Great, thank you, Rick. Okay, we have a motion, we have a second. May we have a roll call vote, please? Jim?
Okay, Mr. Becker.
Aye.
Thank you. Senator DeSanto.
Aye.
Thank you. Chair Philman.
Aye.
Thank you. Representative Franco.
Aye.
Thank you. Treasurer Garrity.
Aye.
Thank you. Ms. Marchowski, on behalf of Senator Hughes.
Aye.
Thank you. Mr. Jordan.
Aye.
And Mr. Thal.
Aye.
Thank you. Mr. Flanagan, on behalf of Secretary Vag.
Aye.
Another unanimous one, Glenn. There we go.
Okay, thank you, Jim. So by unanimous vote, the motion is passed. Thank you.
All right, so we'll move on to the next item, which is me giving a little bit of a sneak peek, I guess, maybe into what's going to happen tomorrow at the education session. I won't go over it in detail because I'll do that tomorrow, and I don't think you guys want or need to sit through twice. But one of the things, the key theme on all of these things I'm bringing to you is simple. We've got a certain amount of assets. We have to pay the benefit. So how can we use them efficiently to generate the income we need to pay the benefit, right? We need to just constantly get better at that, because what you'll see is while we call ourselves investors, right now the fund is kind of in a state of net redemption in order to hit benefit payments. And as board members and as investment committee members, that's a very important dynamic of what goes on inside the investment unit. And so it would occur to me that you would want answers around that very topic. And so that's what we're using these structure studies to provide. So we'll bring up an idea on, a particular idea on how to increase income using option strategies. Those are ways to increase capital efficiency. We'll bring up one idea, but there are more. We'll also talk about how we can sort of think about the allocation and equity differently to, number one, make sure we stay invested all the time. Number two, that we use the entire capitalization structure of the public market before we jump into private equity. And what that basically means is I'll talk to you a little bit about microcap stocks and their relationship to private equity, and the fact that if we can own some microcap stocks, we can own a little bit less private equity potentially, but certainly it'll be lower fees. So those are the sorts of things that help us. And microcap will generate a dividend yield where private equity won't. The other thing is just sort of capping private equity and using the equity portfolio as one big 57% allocation, as opposed to 5 line items that each have their own mins and maxes. I think we can make more sense of the world and stay fully invested a little bit better with that model. And then last, I want to open up, maybe a better way to say it is turn over the rock on strategies that we can use that compete with private equity in return, that have proven themselves to be, at least in my experience, proven themselves to be very useful allocations to help make private equity managers compete for fees. But to be fair, those strategies aren't necessarily simple, and they aren't low fee. While they're lower than private equity, they aren't low fee, and they're still complicated. And the reason that happens is because you're shooting for more return than the equity benchmark, and it just so happens that all the strategies that exist to fulfill that are complicated, and you have to take risks that you have to get comfortable with before you do it. So basically what I want to do is I want to lift that rock, but I won't ask you to make decisions there. I think that would be pushing too hard, and I think it would be unfair to you and the deliberations that you have to take, but we will continue to talk about it. And the last thing I want to talk about is sort of making sure when we know what the liability, the benefit payments are, basically they have them mapped out for as long as you can ask, 80 years, but they're very certain payments for the first 3. Like you almost can't argue that those amounts need to be accounted for and raised in order to pay those benefits, because they're coming, no doubt. So one of the things I want to provide is a way to do that so that we don't have to necessarily worry as much about the liquidity in the portfolio to pay benefit payments. And the reason that's important is if markets get sour on us, or we're trying to work through liquidity problems in markets, that we don't actually need to hit the market to pay the next benefit payment, that's already been taken care of. And what we're doing is planning 2 or 3 years into the future for the benefit payments that are coming. I think that's a smarter way to do it, and I think that will give you as board members more comfort that the most important mission we have is taken care of. And so what that allows us to do then is think longer term about the way we take risks and the way we solve these problems. And I hope that's the collateral benefit of having a program like that in place. But that's really all that I have. I'll certainly take any questions that you have on this presentation as the investment committee before the meeting, but if not, again, we will go through all, I think, 36 or 8 pages tomorrow. And that's all I have on that, and would invite questions. Okay, well, I think that's it for that agenda item. Excuse me. The next agenda item is informational only. And what I'll basically say is the reports in executive session are there for your viewing. If you have any questions, we can do one of 2 things. We can go into executive session, or we would be happy to answer your questions offline about those reports. And for some of the new members on the committee, I do plan on calling you individually with Jim and going through those reports, Jim and Jeff, to go through those reports so that you know they're there, because they do show some of the really good work around transparency that we've been able to accomplish, although like I said, we've got more work to do. So again, are there any questions about executive session material? And if there are, what is your preference on how to get those questions answered? That math must have really bored you guys. I'm going to start with math on item A from now on. Let's just do math problems, and then we'll go over everything. But no, if that's the case, Glenn, then I'll turn it over to you. Done.
Great. Thank you. Thank you. And thank you, Seth and the investment office. We accomplished a great deal today, so thank you. And we have no special presentation planned today. And as Seth mentioned, we're not planning to go into executive session, although there's several informational items that are found on board docs. And please, if you do have any questions that come up out of that, please let us know. The investment office would be more than happy to answer any questions that you might have offline. So,
hey Glenn, can I add just 1 minute of words here?
Sure.
I just want to say how much I appreciate the deliberate conversations we have in this room. They're important to getting better, and I think they have an incredible purpose, and the IO really appreciates it, particularly given that it's in kindred spirit that we have these conversations. So, Glenn, I'll turn it back over to you, but otherwise, thanks everybody for your dedication to the cause.
Great. Thank you very much. We did accomplish a lot today. So any thoughts, comments, questions, concerns from members of the investment committee? Okay, hearing none. Our next meeting is on April 27th. And let the record show that it is 11:42, so we came in under our assigned time, even though we started a little late. So good job on that end. And may I have a motion to adjourn, please?
So moved.
Okay, all in favor?
Aye.
Aye. Okay, motion, meeting is adjourned.